The economy feels like it's spinning without direction. Inflation down, but debt exploding. Markets rising, but investors nervous. Wars dragging on, and new tariffs choking global trade. But none of this is happening in isolation. All of it circles back to the same storm center: Donald Trump. 5 months ago, in our last video, we broke down the 4 factors that looked like a Trump-planned crash: tariffs, global tensions, interest rate pressure, and strategic chaos. At the time, it sounded like a bold prediction. But now, 5 months later, those same factors are advancing. So here's what we're doing today. We're going back through all 4 of those original factors. We'll fact-check what's happened since, what's already in motion, and what it means for investors right now. And we'll show you how Trump's comeback strategy may be accelerating a crash, not by accident, but by design. Before we begin, as always, this content is for educational purposes only and is not financial advice. Investing involves risk, including loss of principal. Past performance does not guarantee future results. Always do your own research or consult a licensed financial advisor before making investment decisions. Let's start with factor 1, and you're going to see why this isn't just history repeating. It's something worse. It used to be a theory. Back then, we warned you that Trump's comeback could come with sweeping economic blows. Today, those blows are here, and they've already hit harder than many expected. Since our last video, Trump pressed the pedal on tariffs again. He slapped universal 25% duties on imports from Canada and Mexico, excluding energy, and piled on extra penalties for steel, aluminum, autos, and even pharmaceuticals in some proposals. The intention was to tighten borders, safeguard manufacturing, and even, he said, protect America from fentanyl and unfair trade. But here's the catch. The legal ground beneath those tariffs just cracked. A federal appeals court ruled most of them were illegally imposed under emergency powers, citing an overreach of executive authority. Still, the tariffs remain in effect, at least for now. Trump has until October to appeal, and behind the scenes, officials are already whispering about alternate legal pathways. Reports from Reuters and WSJ confirm the administration is weighing fallback strategies like Section 301 of the Trade Act, Section 122 for temporary tariffs, and even provisions of the Smoot-Hawley Tariff Act of 1930, which allowed discriminatory tariffs of up to 50% for several months. Economy-wise, the timing couldn't be worse. Global markets shrugged, partly due to confusion, partly due to desensitization, but behind the scenes, stocks started wobbling, supply chains are creaking, corporate profit warnings are stacking up, and consumer prices are rising again. On the North American front, the real story is nuanced. Despite the headlines, USMCA exemptions mean more than 85% of Canada and Mexico's exports still enter tariff-free, including everything from energy to manufactured goods. So, while tensions are real, the delivery is strategic, not a total economic shutdown. And then there's Buffett. He's been outspoken about tariffs as an act of war, and his response tells the story now. He's sitting on historic cash piles, somewhere around $348 billion. It's a signal, a statement, a bet on instability. Trump's rhetoric toward NATO shifted from offhand criticism to explicit ultimata. Pay more or lose coverage. And yes, world leaders are listening. At the Hague summit this past June, NATO members agreed to boost defense spending to an eye-popping 5% of GDP by 2035, double the old 2% goal, with 3.5% targeting core military needs and the remaining dedicated to cyber, logistics, and infrastructure. It's the biggest jump in decades, and it's a direct response to mounting pressure. Not because the threat of war is receding, but because it's intensifying. But that money is going into a moat, not a drawbridge. Europe is rearming, yes, but out of necessity. The war in Ukraine continues, with no real path to a ceasefire in sight. Negotiations are tangled, and mistrust deepens. Russian officials barely engage, European peace plans stall, and Trump's involvement has only added confusion, not solutions. At one point, his envoy delivered an apparent willingness from Putin to offer a land swap deal. No withdrawal from occupied areas, just a tweak in territory, but then reversed himself a day later. It rattled everyone, from Kiev to Brussels. On top of all this, China just rolled out the red carpet for Putin and Kim Jong-un in Beijing. what analysts now call an axis of upheaval. It's a clear signal that, while the West wrestles with internal strife, authoritarian powers are forging rough alliances. Russia, for its part, refuses to entertain European plans for a security buffer or peace guarantees unless they align with its vision, which they don't. The Kremlin refuses to budge on NATO expansion, making any settlement less likely and far more unstable. The emotional impact of these developments falls heavily on investor sentiment. It's one thing to worry about tariffs or rate cuts, but war, or the threat of war, is a different beast entirely. It warps markets, shakes confidence, and invites capital to flee towards safe harbors. That's exactly why Warren Buffett's recent investment pattern stands out. He's strategically added to defense exposure. His firm acquired 5 million shares of United Health, a firm that, beyond being a healthcare giant, plays a vital role in logistics and public health resilience. It's not a feel-good gesture. It's a calculated hedge. Buffett may not be seeking profit in conflict, but he's honoring reality. He knows that when the world grows unstable, defense spending spikes, supply chains reroute, and markets rethink their risk maps. Europe expects to meet NATO's higher spending target, but only a few countries like Poland and the Baltics are already doing it. Others will have to scramble, while budgets strain and economies feel the cost. So this factor isn't some abstract threat. It's already pressing on the global economy, on investor behavior, and yes, on the markets. And it's all unfolding under the headline that the post-war consensus we once relied on is collapsing before our eyes. That is why this isn't simply geopolitics in the background. It's a direct hit on confidence, liquidity, and assumptions. And it bleeds right into Factor 3, where we look at how this chaos may shake loose the very rate policy that defines the economy. You might think crashing an economy is the worst thing any leader could do. But what if it wasn't a mistake but a move? A calculated push to force the Fed's hand? Let's start with the obvious. The FED. It's stuck in a trap. Higher interest rates were supposed to rein in inflation, but now they're crushing economic demand. Consumer spending, the engine of American growth, is cooling. Major retailers just issued warning after warning. Housing starts are falling. Credit is tightening. And yet inflation remains stubborn enough that the Fed won't yet cut rates. This matters because the U.S. is paying over $1 trillion annually in interest on its national debt. Even a 1% cut in rates could save hundreds of billions. Trump knows this, and he's very vocal about how low rates are critical for everything he values: real estate, stock prices, low borrowing costs, and bigger government flexibility. Here's where it gets strategic. Trump has already started replaying the same script that worked in 2020. Attack the Fed. Demand lower rates. Create enough economic pain that keeping them high becomes politically impossible. He's even floated slashing rates to near zero if it means restarting America now. Toss in the market's behavior. We already saw the early signs. Bond yields are slipping, the yield curve inverted, and investors are pricing in expectations of aggressive rate cuts. It's the calm before the storm. Every dip, every recession scare nudges the Fed closer to action. And there's your silent signal: Warren Buffett. He called low rates financial gravity turned off years ago. It warps valuations. It hides risk. March 2020 gives us the pattern. The COVID shock sent markets tumbling. The Fed slashed rates to near zero in just days. The market got back up. That flash of liquidity, cheap money, sent everything skyward. It's the playbook. But if Trump is banking on repeating that playbook this time, the consequences could be even more volatile. Markets may not rebound as quickly if trust is eroded. The Fed's credibility is weaker. The stakes are higher. So where do we stand now? The pieces are moving. The rhetoric is intensifying. Inflation may be cooling, but not enough to stop the narrative. Crash first, cut rates second. From here, it's not just economic cycles. This feels like strategy. And once we unpack this fully, we move into Factor 4, the truth behind the chaos itself. Let's pull the curtain back on the chaos. If you thought these crashes, tariffs, and global tensions were accidental misfires, consider this. They might be the strategy. Trump's playbook doesn't shy away from creating disorder. Instead, it weaponizes it. Since our last update, this strategy of chaos hasn't softened, it's escalated. Trump is pressing emergency rhetoric, openly criticizing institutional norms and pushing legislative maneuvers under the guise of crisis response. At the June 2025 Hague NATO summit, he celebrated a sudden European pledge to boost defense spending to 5% of GDP by 2035. It was presented as unity, but beneath the headlines, it's emergency leverage. Countries like Spain received flexible exemptions, others grumble, but the deal went through. The chaos created the opening. This isn't hyperbole. Controlled disruption gives Trump the power to force policy shifts, executive orders, emergency powers, hardened trade positions, and renegotiations. It's a pressure valve that works on multiple fronts: domestic, diplomatic, economic. Now, imagine how the market reacts. This isn't a naturally born crisis. It's one amplified to reshape the rules. And Buffett has instincts for this kind of environment. Buffett has been vocal about how institutional trust equals economic stability, and sudden rule changes erode investor confidence. That's why Berkshire continues to hold historic cash levels, $348 billion and counting, and why there's no rush to deploy capital. He's watching the game play out. Chaos without clarity devastates markets. The shockwaves ripple through risk premiums, foreign exchange volatility, and investor psychology. This factor cuts deeper, not in macroeconomics, but in how people see the system. Institutions start to look unreliable, alliances creep softer, and every headline becomes a mission-threatening obstacle. So where do we go from here? What it all means for you. If your head's spinning right now, you're not alone. The market feels unstable. The headlines are loud. The data points in all directions. And while it might seem like chaos, there's actually a message hidden in the madness. That message? Preparation beats prediction. Every single time. You don't have to be Warren Buffett. You don't have to anticipate every political move or economic decision. But you do have to respect the risk. Because all four factors we've revisited, the trade war, geopolitical pressure, interest rate manipulation, and chaos as strategy, are real. They're active. And they're starting to work together. The truth is, most people will only realize what's happening after it already hits. They'll wait for confirmation, for a crash to officially be declared. But by then, it's too late. The smartest move right now isn't to panic, it's to prepare. That's why mindset matters. You have to be calm, stick to your plan when the market wobbles. If you can think long-term in a short-term world, you will survive volatility and can benefit from it too. You don't need to be perfect. You just need to be positioned. A little preparation now can make a massive difference later. Here's what you can actually do, practically, simply, and in a way that fits whatever stage of life or investing you're in. Start with your basics. If you don't have an emergency fund, 3 to 6 months of living expenses, make that your #1 priority. That cushion gives you the confidence to think long-term even when the market's in free fall. Next is consistency. One of the most underrated tools you have is dollar-cost averaging. That means putting the same amount of money into investments on a regular basis, regardless of what the market's doing. It takes the guesswork out. And when fear drives prices lower, you're automatically buying more for less. Diversification matters too. You don't need to gamble on a single stock or trend. Blend your portfolio, dividend-paying companies, sectors like healthcare and defense, maybe even a little crypto or gold if that fits your risk tolerance. Keep some cash ready. Liquidity is a strong weapon in chaos. And lastly, you don't need to swing at every pitch. You just need to be ready when the fat pitch comes your way. Want to know what Warren Buffett has been buying and selling in today's market? Click the video on your screen to find out.